So the bulk of the problem, the bulk of the points on the test will definitely be with receivables. So if you're looking for, of course, cash and cash equivalents, bank recs, those are going to be there, but there's only so many problems I can ask. Receivables has a lot of information embedded in it, a lot of journal entries, a lot of adjusted balances, adjusting. There's an adjusting entry. So there's a lot of moving pieces here, which makes it more problem point rich in terms of your exam score. So first things first, if you need, so the chapter 7 video playlist gives an intermediate view of accounts receivable. It doesn't necessarily go back into the basic receivable transactions from 2301. I do have an appendix at the back of the chapter 7 notes that goes through the basic transactions, the journal entries for them, and explains them. And there's a video that goes along with it. So if you need that sort of remedial knowledge on accounts receivable, please do that first before even the chapter 7 notes so that you make sure you have those items down. And I will quickly write them out really quick. To quickly write them out quickly. So if we have a credit sale, and man, if you did the practice problem, you know this. It is a debit to accounts receivable and a credit to sales revenue. We sold something on credit for services already rendered. We can record the revenue by the revenue rec principal, and they owe us the money, right? So that's a credit sale. Cash collection, we have basic one that we have to really think about, of course, is just, hey, I debit cash because I collected it from an account of an outstanding customer. Easy peasy. Um, just basically turning one asset into a more liquid asset, cash. Now, if there are cash discounts, what's going to happen is under cash discounts, the amount debited to cash may not necessarily equal amount credited to AR. So then we have a third account that has to bust in between them because, yeah, debits always have to equal credits. You should never give me a journal entry where your total debits don't equal your total credits. So this can happen with cash discounts. There's really two methods of doing them. There's the gross method, and then there's the net method. So, companies have to choose one. They can't record this batch of receivables with gross and then the secondary batch of receivables with net. You got to go with one and stick with it. If it's a gross method, understand that we are recording. So if it's growth method, the takeaway is that we are recording receivables and sales revenue at full price. And if we're invoking the net method, then we record the receivables and the revenue at the net of discount price. So if the discount's 3%, we record it at 97%. And we record that for receivables and revenue, right? Well, we have to, and that's just the thing. Again, we have to assume something. We made a sale. The customer might pay us and get it within a discount window and get a discount, but we don't know if they will or not. So basically, we either have to say we assume they're not going to pay, they're going to pay us the gross amount. And so I record the receivable and the sales revenue at their full price. Or we believe the customer is going to take the discount. Therefore, we shouldn't ever record the full price, just record the receivable and the revenue at the reduced net of discount price. Okay. And, we can predict what people are going to do, but that doesn't necessarily follow through with what they will do. So if we have a gross method, then if they do pay in the discount, we have cash and we have accounts receivable, but they're not going to equal because under the gross method, if they pay in discount, the receivable was recorded at full price, but the cash they pay, if they pay in discount, will be a net of discount amount. So I'm just going to use percents here. They're either going to give, it's recorded at full price, it means it's 100%. And if it's at a netted discount price, we'll just say 3% is the discount, then they're only going to pay me 97% of that full amount in cash. Well, we need to show this is, the inequality between my debit and credit. I need an account to sort of run interference and plug up this discrepancy. And in this case, I use a sales discount under the gross method. And it explains, wait a minute, I only received, let's say, $97, but the customer's account was $100. But I'm crediting the customer account as if they paid me $100. Why would I only receive 97 but then credit that customer's account by 100? Oh, because they paid within the discount window, so they got a $3 discount. Therefore, the $97 will take away their entire amount, which was recorded at full price. Okay. If they don't pay in discount, it reverts to the simple debit and credit that we saw at the beginning, where I have cash, AR. Well, if they don't pay in discount, they're going to pay me full price cash, and I recorded the account receivable at its full price at the outset. And please don't put any significance behind the fact that sometimes I spell a little bit of accounts receivable out and sometimes I just put AR. I apologize. I go back and forth a lot. They're the same thing. Okay. Same thing with the net method, except it's flipped. Under the net method, I recorded the AR at the net of discount price. And so when I credit the accounts receivable, it's at the net of discount price. And if they paid me within the discount, then I'm going to get net of, they're just going to pay cash net of the discount. They get the discount, so they don't have to pay me the full price cash. Now, if they don't pay in the discount, then we have an issue. We need a special account. And in that case, if they don't pay in the discount, well, they don't get the discount, so they're going to have to pay me full price. But that receivable was not recorded at full price. We're under the net method. And so I'm sorry, wrong. I underlined the wrong thing. We are recording that net of discount. So that receivable was only recorded at 97% of the full price. Now we need 3% to make up the differential, but we need a credit instead. And we'll call the sales discounts forfeited. Okay. Rather than sales discounts because They gave up, they forfeited the discount by paying outside the discount terms. They had to pay the full price cash. This is the forfeit of the discount is why I'm receiving more cash than I'm crediting the customer account. So I think of the sales discount and the sales discounts forfeited account as the explanation as to why my cash and my accounts receivable are not matching up. If they match, there's no need for those accounts, right? So make sure you understand the difference between the net and the gross method and understand why that affects the bookkeeping for both of them. Okay. As a practical matter, most companies roll with the gross method. Okay. All right. So that's cash collections. And this is, you do get some of this in intro, but um, it's not heavily considered. And I do get into like, what is the sales discount account? What is the sales discount forfeited account? How are they different, right? How does it change what we see on an income statement? Those things are in the Chapter 7 video playlist, so make sure you know them. Those things can make good multiple choice questions. So back to our basics, right? Credit sale, cash collection, an account write-off. So this is when we have an outstanding customer account and determine that they cannot pay me. So the idea is I definitely have to credit their account because if they can't pay me, then I no longer expect to receive anything from them. So I'm crediting their receivable. And under an allowance system, where that comes out of is my allowance for credit loss. This is a contra asset account. And this is one that you have to be very familiar with, right? This is an estimate of all the accounts. It's a forward-looking estimate of all the accounts I think are going to go bad. When I actually find one that I believe is bad, I take it out of the estimate. This debit reduces the allowance for credit losses, and then I credit that customer's receivable. All right. Then there is a reinstatement write-off. I'm sorry, reinstatement and recovery. So, in order for a reinstatement and recovery to happen, it can happen simultaneously. Like maybe we wrote off somebody's account, right? That we thought, hey, they're not going to be able to pay us. It's been a while. We should write off their account. And then a month later, this person that I credited here and took away their account from my books didn't think I was going to get their money. They call me up and they're like, "Hey, I can pay you, and I'm wiring the funds or the check. I'm bringing the check by today." Well, when they bring that check by, it is doing both the reinstatement and the recovery at the same time. The reinstatement is just saying, "Oh, hey, I had credited that account in a prior period. I wrote them off, but now I'm debiting it again." So basically, I'm reversing what I did here. And then I very much follow suit and then put their account or that amount of money back into my reserve for accounts that might go bad. So the reinstatement is just the reversal of that piece there. Debit accounts receivable, credit the allowance for credit losses. The recovery is actually collecting the cash from the account receivable. So it's just a simple cash collection that we can perform. Now, if we combine these two into one entry, which you can, because like I said, often We don't even reinstate the account until the check has come to us. Um, but notice, if say like a $10 account, hey, I can pay you. Oh, here it is, $10, $10, $10, $10, right? Well, if I'm debiting accounts receivable and then turning around and crediting it for the same amount, really the debit and the credit to accounts receivable negate each other. And all that's left then is a debit to cash and a credit to my allowance, which I'll do the acronym for this time, for that amount, right? So again, I personally like to break things down as much as possible in this case because it could be that you reinstate, say, $50 of accounts, but only get $40. So this could be imbalanced. But yeah, you can also just bring, if these are the same amounts, if reinstatements match the exact amount that you end up collecting, then you can just show it in one, right? So these are the basic tools we need. These are all things that happen during the period. So in a big picture way, all of this requires customer interaction of some sort, which is to say it happens during the period. And that is being said because I want to make that very clear and different from an adjusting entry, which does not necessarily happen during the period. And that's what we're going to talk about. That's the final piece. So this one, probably one of the most asked adjusting or the most incorrect adjusting entries on the practice set for those that were sending me and I was working with them about their adjustments. And I don't blame you because this tends to be one of the most missed items in intermediate one. When we're doing this adjustment, what we're adjusting for is bad debt expense. And we're crediting the allowance for credit losses for the amount of expense I think I have. Usually, what we do is we take an assessment of all the receivables I have at the end of the period, and I take a percent of those. And I believe that that percent is going to end up being bad debt. And we'll talk about how, and I'll show you how in the problem, how to solve for that value. But the way that we do it is called the balance method because we're using the balance of receivables to predict another balance, the balance of ACL. It could be called an aging method because a lot of the time we're using an aging schedule, and we'll see what that is. But yeah, these are where you need to master first. If you got to get these journal entries down, you will be required, to know all of these entries for the exam. There are a lot of problems for you to practice on, and the practice problem even gave you a little bit of practice with them as well. Let's look at one of the problems that will help you practice here. So, I like these problems because they're two-quarter questions. They make you use a T account and follow it through, not just the end of one period, but going into another period. So we got a company, Norse, and they have a bunch of different balances. Not a bunch, they have two. They have the accounts receivable balance and they have the allowance for doubtful accounts. Don't get thrown off. Allowance for doubtful accounts and the allowance for credit loss are synonymous. Either one is correct. The allowance for credit loss is a little bit more recent because of the change in the standard with some of how we recognize credit losses or bad debt expense. That just came down the pipeline in the past few years, so you're going to still see both used a lot. But this is a relatively newer term. So when working with a receivable problem, I'm always tracking two accounts for sure. I'm looking at the accounts receivable and I'm looking at my ACL or my ADA, whichever one you want to use. Okay. This starts at 361, 550. So we're at the beginning of quarter one. This one, 688 and ugh, 75 cents. All right. So just getting our balances going. They use a balance sheet method with a comprehensive aging schedule to prepare its audited annual reports. So this is just telling me that they're using GAAP and that they're going to adjust for bad debt expense at the end of the period using this aging schedule. So what I give you here are aggregate transaction amounts. Like instead of telling you that, $100,000 were made on the sales were made on this day and 200,000 the next day and then 1 million on the third day. I just throw them all together as a simplifying thing. So we can just make an aggregate entry of all the Q1 sales at once, all of the cash collected during Q1 at once, right? So notice that I italicize gross and I talk about sales discounts recorded. So they're recording their sales at full price. And when customers take a discount, they're debiting a sales discount account. After you familiarize yourself with the gross versus net methods, you'll know that this indicates they're using the gross method. If they were using the other method, the net method, so they're using the gross method for cash discounts. Under the net method, this I wouldn't give you gross credit sales, I give you net credit sales because they would have recorded their credit sales net of the discount. And there would be no sales discounts account. There would just be sales discounts forfeited. Okay. So if we go back and look at those two methods real quick, you'll see if I use the gross method and they pay in the discount, I record a sales discount. If they don't pay in the discount, no special accounting needed, just the two accounts. Right? There's no sales discounts forfeited ever recorded when I'm under the gross method because basically I assume they're going to forfeit the discount when I record it. Under the net method, they pay in the discount, no special accounting needed. I have it net of discount. If they don't pay in the discount, then we need a special account. We need to show that they forfeited a discount. But there's no sales discounts, just sales discounts, period, right? There's sales discounts forfeited, but no sales discounts under the net method because all discounts have been netted when we record it, right? So we're definitely dealing with a gross method. I'm going to do the journal entries for the first one and then post them to the ledger. For the second quarter, I'll probably just end up posting everything into the ledgers, but kind of remove the training wheels at your own hazard. Make sure you know how to do the journal entries before you just start posting things into T accounts. So for the credit sales, that's a debit to accounts receivable and sorry, debit to accounts receivable and a credit to sales revenue for 2,701,500. And that's full price because we're a gross method. So I would just record all as one. Of course, that hits my account receivable account. All right. For the sales discounts recorded, cash collected, I'm using both of these in tandem because this is telling me the actual cash amount collected from accounts. It's not telling me the amount of credit I made to accounts receivable. That's the actual amount of paper cash I got from my customers who owed me money. Now, if I recorded $51,000 of sales discounts, I only record sales discounts as I'm collecting cash, right? Only because I don't know whether to debit sales discount or not until I'm either paid in the discount or not paid in the discount. So I only record sales discounts under the gross method when cash is being paid. So I got paid cash, then I need to record that sales discount. And because I know, right, and we learned the structure of this entry, that means that my accounts receivable is just the credit that will balance this out. Because remember, sales discount is telling me why the cash and the accounts receivable are not equal. Well, this is telling me that basically I'm getting less cash than I'm recording accounts that I'm crediting because some of these accounts that were recorded at full price under the gross method took a discount. So that becomes 2,697,000. This is the credit to AR. Do not put the cash amount in the AR account. This is the credit for the collection. So you have to be careful with that, with the whole sales discount piece. Now, the write offs. Remember, this account is just a rolling estimate of everything we think is going to go bad of this. So yeah, this is the official list of people that owe me money and then and added together all the amount of money that they owe me. But of this amount, this is the amount I don't think I'm going to be able to collect, right? But this is just an estimate. It's not yet a fact. I still have all these customers on my accounts receivable subledger. But then I actually have to write off a customer. It's no longer an estimate. It is a fact. I wrote off somebody for 40,000. Well, think of this as my reserve, right? I've kind of built this reserve so that when I have to write somebody off, it's not completely unexpected, right? But I do take it out of my estimate, my rolling estimate of people that I don't think are going to pay me. I debit ACL or ADA, if you will, if you wish, I should say. And now that I've actually identified specifically who I'm writing off, who I don't think can pay me, I now take it out of accounts receivable. So I debit ACL and credit accounts receivable by 40,000. That takes care of the write-off. The restatement and the recovery. Now notice these are not equal. So I'm not going to just like do them both here as one. I'm going to do a reinstatement and a recovery separately. So people reinstated. The easiest thing to remember, this is the write-off. The reinstatement is the opposite of a write-off. So you just flip the accounts, debit and credit, and record the amount, 5,000, and then post. This credits my ACL by 5,000, debits my receivables by 5,000. Then I had a recovery. The recovery is just a simple collection from the accounts I reinstated. Just extending my T account there for the receivables. Don't worry about the cash account. Cash account is crazy, lots of stuff going on. We're not going to keep track of it, right? We don't really have any beginning or ending for that account, so it doesn't make any sense to track it. All right. These are the accounts I'm tracking. Now, remember, these are the entries that happened during the period. These are the interactions I've had with customers. I made some sales, I collected from them. I wrote off an account of a customer that I don't think is going to pay me. A customer notified me they can pay, and I collected some money from that customer, right? So it does all happen during the period, which means that when I get the balance from these two ledgers, I will have the ending balances for these two, I'm sorry, not the ending balances, the unadjusted balances, because I'm only up to the end of the period. I haven't done adjusting entries yet. When I reconcile these, I get 327,050 as the unadjusted trial balance. Mark that just to keep track. When I reconcile this account, grab my trusty phone calculator. 32. I actually end up with a debit balance of $2,311.25. All right, so let's talk about this for a second. Now, at the beginning of the period, I had anticipated $32,000 of accounts would be bad. Well, even with the reinstatement, I had to write off 40,000. So, did I was my estimate up here at the beginning of the period, was it on point? Was it too little? Was it too much? Well, in this case, it seems like it was too little, right? Because I thought, 32,000 were going to go bad. I reversed somebody that I had written off prior, but that still is only about 37,000 and some change. But I had to write off 40. And so that's why I have this debit balance. What this really indicates, if I have an unadjusted trial balance in my allowance for doubtful accounts or allowance for credit losses, if it's a debit balance, that means that I underestimated debt or bad debt. I didn't have enough in my reserve, right? I only reserved 32,000. I needed, 40, right? It doesn't really matter whether we overshoot or undershoot because we're going to adjust for that when we make our adjusting entry. Okay. But I do want you to understand the idea of this being a debit balance, meaning that we underestimated our bad debt. Or if this is a credit balance, we might have overestimated it a little because it really gives you a working intuition into these accounts. Okay. Now, this is the part where people tend to not quite hit the mark. Now, on the practice problem, you just had a single percent that you applied to the receivables to get the ending balance of ACL. In this problem, it's a little more sophisticated of an approach, but the same idea in spirit. Notice that, and this will always be true. Notice that the total amount of receivables in this aging schedule is 327,050, which is the same amount as my ending balance of accounts receivable that I reconciled for the period. That is not a coincidence, and it'll happen every time. Because instead of just applying, say, 3% to this amount and saying, well, based on all of our receivables, 3% seems to be right, we break our total receivables up into buckets depending on how long it's been since we billed this person, they've had a receivable, and they still haven't paid us. So, 1 to 30, 31 to 60, so on. And notice, of course, the probability of default increases the longer it's been since they've paid us. We can get a bit of a more detailed, accurate estimate by breaking up the total receivables into various buckets of delinquency, if you will, right? But this should still equal 327.50 because that's all we're doing is taking this number and breaking it into how long they've owed us money for. Now, we do basically the same thing. We just multiply across, applying 3.5 to the 140,500 that are less than 30 days overdue. And that is, checking my math real quick, $4,917.50. The 93,000 is multiplied by 4.5%, 4,185. 45,000 by 7.8. It's be 3,510. I'm going to check that again. That looks far too clean. That's correct. And 35,550 and 12%. All right, so now I got basically what I think is going to be bad of this total amount of accounts. So of the 140, I think 4.9 thousand are going to be bad about. 93,000, 4,185 are going to be bad, et cetera, et cetera. Well, if these totaled up, just considering the amount of accounts, not whether I think they're going to default or not, but just the total amount of people that owe me money, if these added up for my accounts receivable, then these amounts of bad debt that I think might happen are going to be what I want my reserve to be in balance. Right. So I add those guys up. Uh, 4266 plus. All right. So I get 16,878 and 50 cents. Starting again. So now we got this total. This should be the balance that we put in our ACL, our adjusted balance. That's where people tend to make the mistake, is that they do not put it as our adjusted trial balance. This is where I want to end up. This is not my bad debt expense. Okay. This is where I want the dust to settle. The bad debt expense is the amount I have to credit this account by to go from the unadjusted trial balance amount to the adjusted trial balance amount. Well, in this case, right, um, we're going from a debit side to a credit side. And it does help a little bit to have that intuition about, well, hey, this is an understatement. This is the amount I want. Not only do I have to debt credit this by 2,311 250, because that would get me to zero. If I have this as a debit balance, now I credit it, it'll be zero. But then I need to add in 16,878.50 more to go from the zero balance up to the balance I want. So these two things together are the amount that I want to adjust by. And together, adding those two, I want to credit the ACL account by $19,189.75. And the debit is going to be to bad debt expense for the same amount. But make absolutely sure that you understand this is not my bad debt expense. This is the first thing I need to solve for to know where I need to end up so that I can determine the appropriate amount of bad debt expense for this. Okay. This is definitely the most missed thing on the test. I will see tons of entries with this amount as the bad debt expense in ACL. Please don't do it. Understand that this process where I'm at a certain point, then I use some calculations to determine where I want to get to. And the entry I need to make is the difference between those 2 points. This, right? That is so common in accounting. Like you'll face this under different contexts for different transactions and adjustments time after time after time. So get with it, understand it, breathe it, love it, and it'll serve you well going forward. All right. So we did all the journal entries. We did the ones during the period for Q1. We did the adjusting entry for Q1. We have everything recorded. That was the very first question. Provide the bad debt expense adjustment for each quarter. We did the bad debt expense for the first quarter. Provide the NRV of receivables at the end of each quarter. That would be reported on the balance sheet. So here is the final piece. What are we going to put on the balance sheet? It's NRV, net realizable value. The net realizable value is the adjusted trial balance amount of AR minus the adjusted trial balance amount of my ACL. As simple as that. So my adjusted trial balance amount is 16,878. And sorry, 16,878. I don't know if I said that correctly. Didn't sound like in my head that I did. And my adjusted AR amount, well, we don't have an adjusted AR amount, but the AR account doesn't change with adjustments typically. You can assume it won't. This will be its adjusted trial balance. So 327.50. Take that difference. And the NRV is $310,171.50. This is what I would see reported on the balance sheet. And again, just make it make sense to you for a second so that you're not just memorizing NRV and NRV is this. What we want to report to our investors isn't the total amount of people that owe us money, but the total amount of people that we think we can recover and collect money from, right? Which would involve us subtracting off the dollar value of people we don't think we're going to be able to collect from. Okay. Um, you can go ahead and do quarter two now and understand that quarter two is going to start at these ending balances for quarter one, right? We're rolling forward into the next accounting period. So this is where you would start your accounts receivable at. This is where you would start your ADA or your ACL account at. And then you'd incorporate the next row of information, right? Figure out what their unadjusted totals are for the second quarter. Remember, this can be your check figure for your accounts receivable that you've entered in all those unadjusted or all those step one entries that happened during quarter two correctly. And then you make your adjustment and then calculate NRV.